In this video, let's cover 4 small cap growth ETFs for exposure to small growth stocks in your portfolio. Guys, you probably think, what do I mean by small and growth stocks? So let's unpack that first. Small cap stocks are companies with market capitalization that is below, roughly speaking, $2 or $3 billion. And anything above that threshold is either mid or large cap stocks. And by the way, this number is not stagnant. It changes over time. For example, if we take, let's say, 10 or 15 years ago, the threshold would be probably around $1 billion. Let's put things in perspective. You probably heard about Nvidia, who haven't, right? Nvidia has a market capitalization of around $4.5 trillion. And that's over 1,000 times more market capitalization than a typical small cap stock. If you ask economists, they will tell you that small cap stocks have done better than large cap stocks. And that is typically true over very long periods of time, like 20 or 30 years. But if we shorten that time period to, let's say, 5, 10 years, that observation and relationship breaks down. For instance, here's a graph that shows returns of large cap versus small cap stocks. Since 1999, small cap stocks indeed outperformed large cap ones. But then, if we start zooming in, the lead vanishes. Over 10 years, large caps smoked small cap stocks, and same for 5 years. So, investing in small cap stocks requires a lot of patience and waiting. And even with that, it's not guaranteed that small cap stocks will stage a comeback. I just wanted to be honest with you here. Small cap stocks are not just some miracle investment that will make you fortunes overnight. And they are very risky too. A small company has less money and human resources than a large one. Also, a small company is just steps away from going bankrupt if its products do not take off. And so that's why small caps outperform large caps. They are just riskier, and investors demand higher compensation in return for taking that risk. Now, let's talk about growth stocks. Growth companies are those that show above average growth rates for sales and earnings. For instance, over the last 5 years, a sales growth rate for an average US public company has been 8%. Earnings growth has been 10%. Pretty good, right? But what about growth stocks? They showed historical sales growth of 12% and earnings growth of 22%. That's over 2 times higher earnings growth. Growth stocks also tend to be very expensive. You probably heard about price to earnings or PE ratio. It is just a company's market capitalization divided by its net income. Basically, it shows how investors value a given company prospects to increase its earnings in the future. Growth stocks tend to have very high PE ratios. For instance, a typical growth stock trades at PE of 30. Conversely, we have value stocks. And value companies are those that don't show explosive growth rates and trade at low PE and other multiples. A typical value stock would have a PE ratio of around 14 to 15. That's like 2 times less than for a growth stock. The idea here is that value stocks are so underappreciated that investors sooner or later realize at some point how great they are, and their stock prices go up. Fingers crossed, of course. Historically, value stocks have done better than growth stocks. But this relationship has broken down, same as with small versus large cap companies. The gap is becoming so wide that some wonder if value will ever catch up to growth. For instance, since 1999, MSCI Growth Index outperformed value by over 2 times. Most of that outperformance happened since 2020. Let's come back to small cap size. As an investor, I do want exposure to this segment of the US stock market. Why would I do that? Here's the thing, the US stock market grew very concentrated, with companies like Apple, Nvidia or Microsoft dominating the landscape. And currently the S&P 500 top 10 stock concentration stands at all-time high of 40%. And this concentration amplifies both gains and future losses. If you invest, let's say, in the S&P 500 index fund, your exposure to small cap stocks would be roughly 1%, And if you invest in, let's say, total stock market funds like Vanguard VTI, the exposure to small cap stocks is a bit better at 8%. Still, that's very low. And as an investor, you may want to increase that exposure. And that's one of the reasons to go with small cap stocks. Growth stocks in the small cap space have historically done better. This graph shows cumulative returns for Vanguard funds tracking growth, value, and blend subsets of the Russell 2000 index. Blend stocks are exactly what they are, a mix of growth and value. We see that on average small cap growth stocks have done better since 2010. But note how growth stocks showed huge drawdowns with lots of ups and downs. The thing is that growth stocks tend to be very expensive with those high PE ratios, price to earnings ratios. For a reason, investors expect a lot from them, but these are just someone's forecasts and opinions, and these opinions may turn out to be wrong. And so these ups and downs that are very pronounced, especially for small cap stocks, are inevitable. And that's something, to be honest with you, you have to be comfortable with. If you decide to invest in any of the funds on today's list, you must have a stomach to live through those painful bear episodes. The first small cap growth fund on today's list is VBK by Vanguard. VBK is incredibly cheap at only 0.07% fee with a gold medalist rating from Morningstar. The fund ranks stocks based on earnings growth, price to book and price to sales ratios, and invests in the most expensive half. The result is a portfolio of close to 600 stocks with a low top 10 stock concentration of 10%. One important thing to remember about this fund is that it allocates a lot more to mid-cap stocks. The number is around 38%. That's like 20% more than what a typical small growth fund does. The benefit of this is lower volatility since mid-cap stocks are less risky. But the disadvantage is that VBK won't give you a true exposure to small cap growth stocks only. VBK leans heavy on small cap tech stocks with almost 27% allocation. Industrial and healthcare stocks follow next, but other than this, VBK sector allocations are in line with its peers. The second small cap growth fund is VIOG, also by Vanguard. There are two other funds that do exactly the same thing as VIOG. These are IJT by iShares and SLYG by State Street. I chose VIOG because it's cheaper, charging only 0.1% fee with silver medalist rating from Morningstar. The main rule that the VIOG ETF follows is profitability. If a given company doesn't show positive earnings in a given year, the ETF will exclude such stocks. And unprofitable small and growth stocks are great when times are great. But when the sentiment sours and times are bad, these stocks can go down fast and stay down for a long time. And this profitability filter is unique to VIOG. I don't see it very often among other funds. But keep in mind that the fund is forced to work with fewer companies. As a result, its portfolio does not show the highest exposure to growth. It has a pronounced value tilt, as we see here. On top of it, it holds about 350 stocks with a top 10 concentration at 11%. Interestingly, because VIOG excludes unprofitable companies, its sector allocations are a bit different. For instance, its exposure to tech and industrial sectors are lower, but it compensates that with higher allocations elsewhere, for example, consumer cyclical and financial equities. The second fund on my list is VTWG by Vanguard. An ETF doing the same thing would be IWO by iShares. Both VTWG and IWO are passive funds tracking the popular Russell 2000 Growth Index. VTWG just happens to be the cheapest one. The fund has a bronze medalist rating from Morningstar. VTWG ranks stocks based on a mix of price-to-book ratio, earnings, and sales forecasts. The fund invests in stocks that land in the most expensive half. Note how there's no profitability filter here. Many unprofitable and risky companies make their way into VTWG's portfolio. For this reason, as we will see shortly, VTWG shows above average volatility of its returns. The fund holds a very large number of stocks, close to 1100. with top 10 concentration at 10%. Keep in mind that VTWG allocates a bit more to mid-cap stocks. That's why its average market cap is a little higher, but not as high as for VBK ETF. Sector allocations for this fund are very typical, but with the exception of healthcare. VTWG admits many more risky and unprofitable biotech companies. Hence, its healthcare sector exposure is way higher. And so that's a risk. And the last small cap growth ETF on my list is ISCG by iShares. The fund charges a very small 0.06% fee and comes with a bronze medalist rating from Morningstar. The fund will give a different take on small growth exposure due to how it defines small size and growth based on Morningstar methodology. Without going into too much details, here's the gist. ISCG scores stocks based on 10 factors. Among them are many valuation multiples, historical and projected growth rates. The selection process is meticulous and way more sophisticated compared to other funds. Also, ISCG will invest only in the bottom 9.5% of US stocks ranked by the market cap. The result is a collection of over 900 names with a top 10 concentration of only 5%. That's the lowest number on my list. ISCG allocations are similar to its peers, although it allocates a bit less to tech stocks, but more to real estate equities. If we compare how these funds performed, surprisingly we see that their cumulative total returns have not been too materially different since 2010, although we see that VIOG took a lead here and there. I think a lot of that had to do with how VIOG screens out unprofitable companies and has a higher tilt to value of the 4 ETFs. If we look at volatility adjusted returns for the past 10 years, here's what we see. Unsurprisingly, VTWG ETF showed higher volatility as measured by the standard deviation of returns. That has hurt its Sharpe ratio. Sharpe ratio takes returns and divides them by the standard deviation. So a fund with lower volatility will have higher Sharpe ratio, keeping other things constant. Surprisingly, ISCG did very well and close to VBK on volatility adjusted basis. And here's a summary for you guys. All 4 funds are passive index funds. They charge very reasonable and low fees. VIOG and VTWG invest in some of the smallest companies, hence their average market is low, but VBK allocates a lot more to mid-cap stocks, so its average market cap is quite high. Only VIOG screens out unprofitable companies, but surprisingly that didn't give it any meaningful edge over other funds. That's unlike what I've seen with small cap value or even small cap blend funds. It seems that profitability filter made some difference there, but not here. At the same time, it looks like VIOG has the biggest tilt away from growth and to value factor as we see from its valuation multiples. Finally, only VBK is rated with gold medalist rating from Morningstar. I don't think you will go wrong with any of these ETFs on today's list, although they cater to different preferences depending on an investor. For example, if higher exposure to mid-cap stocks is okay with you, then a VBK ETF is an excellent choice. Conversely, we have a VIOG ETF, which appeals to risk-conscious investors by controlling for profitability in its portfolio. Conversely, both ISCG and VTWG cast a wider net across a more diverse group of small-cap stocks with a growth focus. Although VTWG admits many more tiny unprofitable companies into its portfolio, which is evidenced by its negative return on capital. On a final note, I was quite surprised how fewer small-cap growth ETFs are out there, and there are many more small-cap blend or small-cap value funds. And the reason probably is because they're just not that popular among investors. Maybe it's too risky for most. The goal for this video was to choose ETFs with proven track record, low fees, and established asset base. There are many other unproven or expensive small-cap growth ETFs that I chose to overlook. If you would like to see the entire list of small-cap growth ETFs and do research on your own, check out Morningstar, linked below. It's a great resource to research funds and stocks. And that's all for this video. Do you have your own small cap growth ETFs to add to my list? Let me know below. Also, if you would like to learn about small cap blend or small cap value ETFs, check out videos linked here. Thanks for watching and all the best!